Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And I'd like to welcome you to the summer series where I review and replay 3 of the most popular episodes during 2022. The first one was about economics. The second most popular one was consistency over intensity. And the third placed episode is the 3 steps I use to develop a financial strategy for clients. So the idea behind this episode was that I thought it'd be interesting to kind of share how we go about building a financial plan so that people kind of understand what's involved and that it is quite a strategic process that we do it in a number of steps. To make sure that we end up with a really coherent, good quality long-term plan. So the first step is really developing the strategy at a high level. So we try not to resist the temptation to get buried in the detail. Once we've got a high-level strategy, how much in property, shares, super, gearing, buying a home, all those sorts of things. We then develop the detailed advice that underpins that strategy. And then the third and final step is implementation, of course. So anyway, I want to share this episode, and whether you're listening to it for the first time or, it's a good reminder, I hope you enjoy it. And I'll be back next week with my regular episodes. Okay, now on to the episode. Cheers. And in this episode, I'd like to talk about the 3 steps that I follow in order to develop a financial plan for my clients. Now, a few weeks ago, I released a podcast episode about, talking about the thing that I think stops people from making the most of their financial opportunities, including investing regularly. And it was my thesis that a lack of context is the main cause for that. So that is, having a long-term plan provides you enough context for measuring decisions against, and therefore, avoiding making the wrong decision at the wrong time, investing in the wrong assets, those sorts of things. Look, it's very difficult to really work out what investments you should make and when if you don't know where you're heading and how to get there. I mean, again, the analogy that I used in that podcast episode was like going and asking someone for directions, but without disclosing your destination. It's just impossible for people to give directions in that case. So a financial plan will really give you, a long-term financial strategy will really give you that context for measuring those decisions. Now, over the past 2 decades, I have developed and refined a 3-step process for developing a plan for a client. And found that this sort of discipline and logical approach helps us develop very effective and efficient evidence-based strategies. And that's what I want to talk about, these 3 steps. Okay, so let's start with step number 1. Should be no surprise. So step number 1 is develop your strategy at a high level first. Step 2 is then develop the detailed advice that underpins that strategy. And then step 3 is really around implementation, review, and refining the strategy as changes evolve. So they're the 3 steps. Really important that you go through those 3 steps and that you follow, you keep it a high level, step 1. You can get into the detail only when you get to step 2, etc., etc. So let me now spend a bit of time talking about each of those steps. So as I said, the step number 1 is develop a high-level strategy. So that's really about working out, how much surplus cash flow you're going to have over the next period of time, and then how to allocate that surplus cash flow and what other changes to investments you might need to make in order for you to be able to achieve your goals. So, for example, it might be, look, I'm going to work for the next 10 years. I've got a $50,000 a year surplus cash flow. I want to retire in 10 years' time. I need $100,000 to live after tax, obviously. And what am I going to do with that $50,000 or $500,000 over the next 10 years in order so that I can achieve my goals? And to answer that question, the best way to do that is to really build a financial model. And a financial model should forecast out all your income and expenses, not only while you're working, but also into retirement as well. And then that'll help you determine what surplus investable cash flow you actually do have, either before you retire and even post-retirement. And then also that cash flow should then filter out into a forecast of your assets and liabilities over time as well. So you want to sort of get a picture of how your net worth changes over time. There's two purposes for a financial model. So it needs to do two things. The first one is it needs to measure whether your strategy is actually going to work. So that is, if you do X, Y, and Z over the next 10 years, is that enough to help you achieve your goals? Of course, you need to make sure it's going to work. The second purpose of the strategy is to compare different strategies. And that'll either eliminate inferior ones and then pick the one that has the highest probability of working. So that is the one that generates the highest return for the lowest risk. Now, they're the two purposes for financial modelling. It's not about trying to guess or estimate or crystal ball gaze about what your financial position will be in 10 years' time. That is kind of irrelevant. It's really, will your financial position be enough in order, generate enough income and capital gains in order to fund retirement without any longevity risk, so without running out of money. Now, it's true that financial modelling, to financial model a client strategy is sort of part art, part science. The science bit is the Excel skills and the technical skills and the tax and investment knowledge and so forth. That you can, I was going to say easily replicate, probably not that easy, but you can replicate it. The art bit is the experience of developing hundreds, thousands of strategies over a long period of time allows you to work out what strategies are going to work best in what scenarios and what circumstances, and also what risks to avoid as well. So it's true that realistically, most people that are listening to this podcast probably aren't going to have enough skill in order to develop or financially model out their strategy, but also, and probably most importantly, not enough experience to do it as well. But I thought it was important to still talk through, what is the process in order to develop a good, robust strategy, so that you've got a sound understanding of that. And then if you do go and see a financial planner and they don't go through this process, I think it's a bit of a red flag. Now, remember, once you've built your financial model, it's then about working out, okay, which asset classes I'm going to hold my wealth in. So either which investments that I currently hold do I need to divest of for a variety of reasons, and the most important one could be underperformance. And then where am I going to reallocate those assets? I believe that most people would be well served by investing in various asset classes. So property, some shares, hold some shares inside super, outside super, maybe even commercial property, which I've recorded a couple of episodes about in February, I think, on this podcast. But really, financially modelling it out allows you to really better understand what combination of asset classes best suits you in terms of risk profile and appetite, and also helps you achieve your goals. The other benefit of financially modelling is to understand what level of gearing, what level of borrowings is going to best suit you. So there's two main things that you need to consider. How much debt you're happy to service. So, do you have the cash flow, and will you have the cash flow in the future to deal with loan repayments and debt repayments and so forth, particularly as interest rates rise? And then secondly, how that debt behaves in the long run. I mean, if you've got, 20 or 30 years away from retirement, by the time you get to retirement, the debt's probably going to be immaterial because obviously inflation eats away at the value of that debt. But everyone must consider, what is their debt retirement strategy. You don't want to take a lot of debt into retirement, be sensitive to interest rates, because that could obviously, upset you in terms of being able to fund retirement. And of course, when you're financial modeling these things out, it's important to make sure whatever strategy you come up with can be implemented. So you're going to need to really consider your actual borrowing capacity, in terms of how much will the banks lend you and so forth. The other thing you need to consider while financially modelling this out is ownership structures. Once you've worked out your cash flow and then you've worked out what sort of asset classes you want to invest in, that then typically, or that information typically helps then inform you about sort of what ownership structures you might want to put those assets in, and you can model those things out. Some things, common considerations that you're going to need to take into account is income tax payable over your lifetime. So that's not only sort of how does the asset behave from a income taxation perspective while you're working, but also in retirement. Land tax, if you're investing in property. Capital gains tax, if your strategy requires selling down assets, or there's a risk that you'll need to sell down assets. Of course, current and future projected cash flow, you'll want to make sure that you've got enough money to live. Borrowing capacity, asset protection, those sorts of things will help sort of determine what are the best ownership structures. Now, it's very tempting at this stage one, to get involved or get dragged into the detail. If I'm going to invest in property, where is that property going to be, etc., which buyer's agent I'm going to use, all those sorts of things. It's really important to not get dragged down into the detail. Keep it high level. What you really want to work out is, okay, when am I going to retire? How much money do I need to fund retirement? And what are the steps that I need to take over the next X number of years in order to make that goal a reality? So it might be I need to invest in a couple of properties, maximize super contributions, make some regular share investments, etc., etc. That's what you want to develop, that sort of high-level strategy at this first step. If you get bogged down into the detail, you'll likely confuse yourself, you'll end up going around in circles, and you'll end up probably developing the wrong strategy. So really that number one is the high-level detail. Okay, so once you've completed that first step and you really do understand what your long-term strategy looks like at a high level, you then need to develop the detail that underpins that strategy. And the first, the most important part of that is really to work out what sort of methodology or philosophy that you will adopt in order to help you implement that strategy. Anyone that's a regular listener to this podcast will understand that I constantly bang on about using evidence-based investment methodologies, and that's because I believe that using evidence-based investment methodology reduces your investment risk significantly. If I can point to a whole body of evidence that says if you follow these rules, if you want to invest in shares or property or whatever it might be, and if you had followed these rules for the last 30 years, here's the results, here's what the results would have been, and the results are good, well then why go and reinvent the wheel or take the risk that you're going to adopt a methodology that isn't backed by that evidence? So when it comes to investing in shares, you're going to need to think about what sort of methodology do you want to adopt. Will you adopt that evidence-based approach? Will you try and pick shares yourself or use a stockbroker? Will you try and pick active fund managers to try and beat the market, etc., etc.? When it comes to investing in property, are you going to try and find this next growth suburb or growth corridor and get in early? Hopefully you hear the skepticism in my voice there. Or are you going to use a rules-based approach to invest in property? My book, Investopoly, which obviously this is the name of the podcast, but really goes through all those evidence-based methodologies that I adopt personally and professionally. So if you need to know more, you can obviously reach out in regards to that. You're going to need to think about, what to do with your super. Everyone's forced to invest in super. Self-employed people aren't necessarily, but should still invest something in super each year. So you're going to need to work out, where's your super invested and is it working hard for you and so forth. And don't be lazy with it. I mean, a lot of people, I'll get to that. And they're with a retail fund, and they're getting ripped off in terms of really low returns and high fees. Sorting out your super is a lot simpler than what it might seem at face value. So you need to work out what to do there. Whether you're going to go with the industry super fund, a wrap platform, or set up a self-managed super fund. Either way, make sure that it's appropriate for your circumstances. So if over the last 10 or 20 years you paid very little attention to super, then my argument might be, or I'd invite you to think about, are you really going to pay a lot of attention to super over the next 10 to 20 years? If not, go for something that's really hands-off. Don't set up a self-managed super fund if you have a history of not managing money well or making good quality investment decisions. You're probably better off just to outsource it, find a really good, another good method to invest your super and kind of outsource it. You need to then work out borrowing strategy. Once you've developed your long-term strategy, you really understand what sort of borrowings you're going to need in order to implement it. So what you need to do there is build a good relationship with an experienced mortgage broker that really can develop a borrowing strategy for you and then help you implement that. I think that's a key one, because if we can all access an unlimited amount of borrowings, let's assume that it's affordable to do so, that can help us build a lot of wealth. And finally, in the step number 2, which is the detail, there's a couple of other matters you're going to need to consider. Now that you have a really well thought out long-term investment strategy, it will really help you understand how much insurance you need. And I'm talking about personal risk protection insurance, things like income protection, life and total and permanent disability insurances, those sorts of things. Now, once you have a good long-term strategy, you'll really be able to work out how your insurance needs will change over time. Because obviously, if you're in a situation where you've got a relatively weak asset balance, you've got a home loan, you've got young children, etc., you're probably kind of at the peak of your insurance needs. But if you then have a strategy on how you're going to move forward, kids will get older, of course, and so that your financial commitment will be reducing. Over time, you'll be able to repay your home loan. Over time, you're investing and building your asset base. And as a result, you'll need less insurance. So it provides a really good forecast or forward-looking view of what your insurance needs look like, and then how you're going to manage the cost over time. So you're going to need to think about, insurance. And one of the things in an investment strategy is one of the key assumptions is that the clients will generate a certain level of income for a certain time. Now, if we assume that they're not going to do that, if we remove that assumption, then the whole strategy fails typically. So that's the key risk that we need to insure against, but we want to have a strategy on how to manage insurance costs over time. The second ancillary item is estate planning. So now that you know what sort of asset base you're looking at and what sort of ownership structures you'll be using, that'll help inform you on how your wills and power of attorneys and those sorts of things need to be structured. Okay, so step number 1, high level. Step number 2, get into the detail. And then step number 3, arguably the most important, because a fantastic plan that's not implemented is worthless. And step number 3 is really implementation, review, and then refine the plan over time. So when we talk about implementation, just typically I can run you through a list of things that we might work on over the first 1 to 2 years for a client. That could include things like strategically divesting of any underperforming assets. If they've got any property or shares that we don't like or we don't think is going to generate good quality returns in the future, then we need to divest of them, not necessarily straight away. We want to be strategic about maximising value, of course. Optimising super, which could include rolling over to a different superannuation arrangement or super fund. Making property investments, and if the plans to invest in 2 or more properties, need to really then think carefully about the timing of those investments and locality and so forth. Often we'll commence some regular share investing for clients where cash flow allows. We might refer the clients to an estate planning lawyer to get those estate documents worked out. Review their insurances and make any changes in regards to that, given we've now got the context of that longer term plan. And then complete some taxation planning, which could be setting up new structures or restructuring existing structures in order to, again, accommodate our long-term strategy. So they're just a few items that we'd need to work on in implementation phase that they're probably relatively common amongst clients, but of course it could be different in your circumstances. So typically that first couple of years, there's quite a bit to do in terms of implementation. Now, if there's one thing that never changes, it's change itself. almost guaranteed as soon as you think things that aren't going to change for a while, that almost Murphy's Law almost is that they will change tomorrow. So, of course, your plan needs to be flexible enough to navigate those changes. I find, in my experience, most plans are, just by definition, relatively flexible. And there's only probably a handful of times we've needed to sort of throw out the current plan and start again because the changes have been so significant. But, of course, we need to sit back and think about, okay, if my situation has changed, do I then need to change my investment strategy? And realize that most of the time the answer is no. Although it's tempting to go and change it, the answer is typically stick to the strategy that'll serve you best. Of course, regular performance reviews are important as well. So that is making sure that investments are performing well. But realize that, playing the long game requires a lot of patience and discipline. To ride through periods of low market returns, and in some cases, because investment returns are rarely distributed evenly each year over 20 years. For example, you'll go through periods where certain sectors of the markets or sub-asset classes will underperform. But if the fundamentals of that investment are sound, then you've really got to have the discipline and patience to ride that through. In fact, I'm going to do a podcast episode about that very topic in a few weeks' time. So there you have it. There's the 3 steps to developing a financial strategy. It stands to basic logic, I think, and reason that if you have a well thought out strategic plan for yourself in order how you're going to create some financial security and an asset base that will allow you to enjoy a comfortable retirement, that is a far more successful approach to doing that and achieving those goals than making ad hoc financial decisions. And then hopefully this episode is giving you some insight to the work involved and the best process to take in order to develop that strategy. Okay, thanks for listening as always. Until next week, bye for now.